Hi guys, welcome back to the channel. My name is Dave, and over the last few years we've had a ton of different covered call ETFs come to market. We've talked about a bunch of them right here on this channel, but I often get the question of what about put selling? You always talk about selling puts yourself. Are there any ETFs that cover this area? And there aren't very many, but we do have a few, and today we're going to talk about one. It's OVL. It comes to us from Liquid Strategies, and it uses put credit spreads to generate a little extra income. And I think it might fit really well with my whole soup bowl concept, which is registered and trademarked at this point in time. If you've been following along, you know what I mean. But I think it's kind of interesting and might fit well with this idea to generate some tax efficient income put in your pocket. So if that is what you're looking for, please stick around. Whoop. Now stick with me on this because I know I'm going to have a few people that are going to turn this off when I say the distribution rate for OVL is around 3.5%. That's not very exciting, Dave, and I get that. So it offers about 0.5% over what the S&P 500 offers you on a quarterly basis. But again, stick with me because we want to attack this income problem with different approaches, right? We want to see if we can meet the performance of the S&P 500, but do it maybe even more tax efficiently than we could by owning something like VOO, receiving some qualified distributions, and then selling some shares as we need them. Can we be even better than that? Well, let's think about a makeup of a portfolio here to get started. Okay, so let's talk about some of the products we've talked about so far and return on capital. A few weeks ago, I did a video, I'll link it up above, about my taxes in 2024 from all these different products that I received. So let's imagine a comparable portfolio, owning VOO or owning these three products. And I'm going to use SPYI from NEOS. We've talked about that one. That in 2024 offered me 94% return on capital. So it was very tax efficient on the 12% distribution rate that it had. So we got 12% so far. And that's on the very high end for me. I think anything over that, it starts becoming less practical. I think it's going to start hurting my basis. So I want those distributions, but I also want some growth. So I'm looking at this, looking at distributions and growth. So that 12%, very tax efficient, but on the very upper end, right, of what the S&P 500 can offer. Over the last 50 years, around a 10% annualized rate of return. Okay, so if we're looking at this and saying 12%, we're reaching already a little bit, right, with SPYI. Then I want to mix in QDPL. Okay, this is one that does dividend stripping, all right, and offers around 4 times what the S&P 500 offers, or around 6%. So now we have one product that's selling covered calls. We have a second product offering dividend stripping, and then we're going to mix in this OVL product. It only offers around 3.5%. But it does it through put credit spreads, attacking the problem from a different angle again. And this is my soup bowl method, right? So mixing these products together, we have 12% plus 6%, that's 18. Another 3%, that gets us a little over 21%. Divide by 3, if we did it equally, 33% in each, we would have a 7% distribution rate that is very tax efficient. Does that meet your goals? Could this work for you? And just to finish that thought, as far as tax efficiency on these products in 2024, SPYI was 94% return of capital, so it would have been very tax efficient on those distributions. QDPL came in at 82%, so again, very tax efficient for 2024 based on their strategy. And with OVL, I did not own it, so all I can look at is the 19A1 notices for last year, and there was some return of capital included in those, but that can change. I like to use what was actually reported to me. So I would expect some return of capital, but not tax advice. And it's only 3% of the 21% we discussed there. So even if there was some, it would be a small amount. And you'll see that with their strategy, it's all going to be pretty tax efficient anyway before we even get to ROC. So OVL comes to us from Liquid Strategies. This is I wasn't aware of Liquid Strategy. I had somebody reach out to me and say, hey, check these products out. And that's exactly what I'm doing. I found this one pretty interesting. And I get that question again on put selling. So this is the Overlay Shares Large Cap Equity ETF from Liquid Shares. It owns the S&P 500, and then it sells put credit spreads. And we'll get into that a little bit more, but that's the strategy. And that's pretty much it. Let's check out some of the facts and understand what we're getting into here. And one of the things I love about this is this has been around since 9/30 of 2019. So they're trying to blast this out now, trying to get more eyes on it because it has performed very well. But it's cool that it's been around for 5 years and it's an option-based ETF like this that we can use and dig into a little bit more. Expense ratio is 0.79%. That's pretty high for what it offers here. I don't like those expenses being that high, but it does have pretty good performance. So I guess you can look at it that way. But I always like to see competition coming into this area and hopefully driving that down over time as well. But 0.79% means $79 for every $10,000 you invest. But keep your eye on those expenses. They can hurt you over the long run. It's got $204 million of assets under management. So decently sized fund, but has been around for a long time, 5 years. And yeah, that's it. Let's roll it down and let's check out what's actually in this. And as I mentioned, it's pretty straightforward. So if you've been watching my channel, you know that I buy VOO, that's the S&P 500, and that makes up 99% of the holdings. And then the rest of the income that they're going to get, and by the way, this distributes around, 1.5%, 1.4, somewhere right around there. That will be qualified distributions coming out on a quarterly basis, so that will be tax efficient. Then on top of that, we're going to use index options, in this case SPXW, and we're going to do put credit spreads, trying to take in small put credit spreads. You can see right now we have 4 pairs here. We have 91 with 91, 93 with 93, same here, and then 85, 85. They do this over about a 2-week period. So we have 4/9 expiration, 4/11, 4/15, and this one's kind of funny that they put it in differently, but it's 4/25. So there are good times to own SPYI. There are good times to own OVL, and mixing these together, it's kind of exciting, right? Because SPYI has suffered over the last 2 years that it caps the upside, and we've been in a rising market, so it's missed out on some of that. So you've seen large amounts of return of capital. 2024 is 94%. Part of that is because the option strategy was not working. They don't always work in every instance. This would have been performing very well over the last couple of years because they're playing on the put side of the option chain, right? And they're taking in credit. But over the last few weeks, it would be really bad. Okay, so and this will show you that right now. If we go over and we look at the SPX, hopefully you can see that 56.36 is where we sit right now. If I look at our different spreads here, we've got it starting at expiration on 4/9. By the way, today is 4/1. So we're sitting at 56.36, and this is a put at 5,700 and 5,800. So this is the short leg that they sold. This is where they're taking in credit. This is where they are selling some of that, right? So we're defining our risk. If you're not familiar with that, don't worry about it too much. We won't go into too much depth here, but we're basically saying we want it to stay above 5,800. It's already below. We want it to, at 5,700, this offers us protection. So we get to our max loss at 5,700. So this would be max loss currently at expiration. And when we get to 4/9, if it stays at 56.36, we're below that. You can see as they've been selling out further here, they've been getting more adjusted to the current price. So 56.36, we're at 56.50 and 55.50 down here at the bottom. But all these would be losers right now, I assume. I assume they put this on a couple weeks ago. Or actually, no, they probably put this on fairly recently. So it looks like the strategy is to do put credit spreads that are out around 2 to 3 weeks. They do it over 4 positions. I like that strategy. It kind of reminds me of GPIX that layers those in on the call side. This is on the put side. And it's not spreads with GPIX either, but I like that strategy where they're staggering those out around 4 weeks out in the future each week. So that's the strategy. Right now, it doesn't look good, but we'll look at performance over 5 years and we'll see how that stands right now. So these don't look very good. SPYI would be looking pretty good on their option strategy right now. But that's the whole idea, right? We're mixing this into a soup bowl. Again, call side, put side, dividend stripping, maybe different strategies that work out well together and make up our soup bowl. Now let's jump over to Seeking Alpha and take a look at OVL. And as you may have heard, I am a Seeking Alpha affiliate, and their affiliate links down below. So if you're looking for a stock and ETF research tool, I know it's great commercial. then check out Seeking Alpha. But if you want to know about OVL, you're not going to go to Morningstar and find information. You're going to find it here on Seeking Alpha. You're going to find analysis from all kinds of well-intentioned people. I might not agree with all of them, but they're well-intentioned, and you can read some great articles because you're not going to find this other places. Meaning, yes, Morningstar is going to review VOO and let you know what they think about the S&P 500 ETF, but probably nothing about OVL will be on there. So best place I have found is Seeking Alpha, and that's why I'm always on here and why I talk about it. Anyway, as we talked about, expense ratio is fairly high, 0.79%. Not a lover of that. It distributes on a quarterly basis, not monthly. I know some people love that monthly distribution. This one is a quarterly distribution. The yield around 3.3%. So if you think about the S&P 500, it's about double that. Assets under management, 203 million. And then you got all that analysis down here. Okay, so what we really want to do is take a look and see how it's performed. And that's one of the things that got me to talk about this. I check out performance. I want to see how this is doing. And it's not going to vary too much from the S&P 500 because it's pretty simple, right? The majority is the S&P 500. The majority of this fund is this. It's just got an option overlay. So is the option overlay effective? Well, in a rising market, we're going to see that. And that's what we see here. So it's giving you that little bit extra. So why consider this, Dave, if I can just own VOO and it costs me less? Well, we're getting slightly better performance. Over the last 5 years, total return, all those distributions, 150.8% versus 146.2. So you're getting a little bit more based on the last 5 years using that put credit spread. I like that. That's good. It's also tax efficient. So for me, this could be a winner for the right person that's looking for that double distribution, right? Hand it over to these guys and let it rip. So that was stage one, and one of the reasons I wanted to review it, because it has outperformed the S&P 500 and is doing it in a tax efficient manner. Good job. Then let's compare it. Let's take it a step further. And I thought, well, let's throw these other products in there. And that resulted in a video that you're watching today. So again, we're looking at total return, all distributions factored back in. And I went back to the inception date of SPYI. And here's what I see. I see OVL offering 43.86%. Okay, since inception, 945 days worth. VOO over the last 945 days, slightly better. QDPL, not too far behind, but offering about 4 times the distribution rate. Again, that's factored into this because we're looking at total return. And then we have SPYI that since inception's lagged all these at 33.21%. Still pretty good, but it is lagging. Now, why is that? Well, without researching much, this is where you see capping the upside on those calls affecting this product, giving us underperformance. So that can happen in a rising market. Now, in a declining market or a sideways market, I would expect this to outperform and this to outperform both this and this. So again, we're putting all these strategies together and we're seeing what comes out. But this could be a very effective way to strip off around 7% in a tax efficient manner. And that's one of the reasons that I'm kind of attracted to this idea, and I'm presenting it here today. Now, from a numbers standpoint and using my numbers from tax year 2024 and the video I referenced that I'll link down below, I get the following assuming my estimated tax rate. So first, let's think about a portfolio of 100% VOO or the S&P 500, and this is in a taxable account. My assumptions look like this is going to be right around 17%. And if you sold shares along the way, that would also be taxed at around that same rate. Remember, this all depends on your income, so you might fall in the 0%, 15%, or 20% bracket for long-term capital gains. I don't know your situation, not tax advice, so I assume something high, a high rate in this case, 17%. But following that same logic and looking at return of capital for portfolio 2, we start with SPYI, and that ended up being at 1% for 2024 because of that large amount of ROC associated with that product. QDPL ended up at 3.32%, again, from that video and all that ROC. And I'm going to assume OVL ends up at 13.68% for convenience. That gives me an overall rate, I want to add those together, of 18% or 6% across the portfolio, assuming 33.33% investment in each fund. So from a tax perspective, by kicking the can down the road a bit on the tax side, until we fall into a lower bracket at an older age. Maybe we retire. We are saving a bunch now based on our assumed tax rates. Just, something to consider. So let me know what you think about OVL from Liquid Strategies down below. For me, this looks like it attacks the income problem with a different strategy. We're using put credit spreads, taking in a little bit more income, distributing it in a tax efficient manner, and maybe it could work out for a portfolio when we pair it up with the right products. Performance over the last 5 years is really impressive, right? We're outpacing the S&P 500. So could be a good one to keep your eye on. The only thing that I'm not a big fan of course, is that expense ratio. Wish we could do something about that. But overall, a well-built product, definitely worth checking out. So again, let me know down below what you think. If you like this type of content, like and subscribe. I don't throw that in there enough, probably. So come along. And we'll see you next time. Have a great night. Take care. Whoop.